Let's move on to Tata Chemicals. Our Mukundan, the Managing Director and CEO, joins us on the show right now. Mukundan, hi, morning, good to have you. What are the highlights of the quarter gone by? Walk us through the quarterly performance.
So I think broadly speaking, the company's revenue has increased broadly 10% to in some segments as high as 22%. So the growth is tracking. Also the company has managed to protect its margin broadly despite pressure from the rising energy cost, which has been the biggest issue which we've been facing. We believe while the margin percentage may have come down marginally, by the time we go to Q4, it should again track up because we are currently not able to move some of the pricing despite a tight market condition because of contracts we have. Those contracts unwind during Q4 of this year. So we do expect the margins to further improve by the time we hit Q4 of this year.
What was the growth across the key markets and revival that you may be seeing in Africa and US after a soft Q1, and what are the trends that you're seeing in the standalone business as well, if you could highlight the same?
Both Kenya and US have done a better performance than what they had in Q1. If you recall, Q1 Magadi had impact of heavy rainfall and flooding in the lake, and that's behind them. And they would continue to improve going forward, and we expect them to trend back to their normal numbers during Q3 and Q4 too. As far as the US operation is concerned, it has done better than the previous quarter, but has done about 50,000 tons less than the same quarter previous year. And that reduction has come mainly because of a hookup of environment improvement equipment which we had to do in this quarter. But the performance is trending back to normalcy as far as Q3 and Q4 are concerned. So we are back to where we are. We are producing in every plant of ours 100% production. So our capacities are full, which is one of the reasons why the board has approved a further expansion and investment of 2,400 crores.
Thanks so much for taking time out and joining in. Mr. Mukundan, what is the growth that you're seeing in the consumer business? Can you tell us which products are seeing a better offtake and the new ones as well that are planned for launches?
In terms of consumer product, our growth rate has been about 22%, and we expect the current trend to continue both by the same store performance, which should trend and improve, as well as increased number of stores for our new products, which is pulses, spices and all the mixes. As far as salt is concerned, it's going to come through increased penetration into our underserved markets, mainly in the rural as well as eastern and southern part of India. So those would tend to grow. So overall on the consumer side, we continue to see very, very strong demand. I would not go into segment-wise growth numbers because while overall percentage is 22%, some of our segments like pulses and spices have grown at in excess of 130%. That number has, I think, little relevance because they were growing off a very small base. So the growth would continue. As far as new categories are concerned, we are working on a couple of new categories, and we will announce them as and when they are launched, and we'll announce them when we see you in the next couple of quarters.
So how is the scale up of the consumer business now progressing? Where are you aiming for a higher market share, and by when will we see consistent segment profitability?
The segment profitability is fairly consistent. I think the segment profitability was about 68 crores in the same at EBIT level last year, and in the current quarter it has increased to 86 crores. The quarter one was, I think, again close to about 84 odd crores. So broadly the segment profitability is now in 80s. It used to be in 60s, and every year it will tend to grow further depending on the revenue growth. And as I said, the revenue growth is clocking something like 22%. Quarter on quarter.
Right. You know, rupee has also depreciated a good 13% so far this fiscal and 7.5% in the last 4 months. Could this lead to a revision in prices of soda ash contracts for FY20?
You're absolutely right. I think the soda ash pricing is related to the import parity pricing, so it should naturally get reflected, and we will keep adjusting it as we see the rupee trend up, and our effort is just to protect our margin.
Okay, and what is the consolidated revenue and profit growth outlook improvement as well that we could see potentially in your EBITDA margins? What are you working towards internally?
So I said we don't guide. All I'm trying to explain is some of the contracts where we were not able to increase the prices would come up for tend to go back to the and reflect the price increases which are reflected in the market, and hence we expect the margin conditions to improve in the basic chemistry business. As far as the consumer business is concerned, it should continue to show consistent performance.
We wish you all the very best. Many thanks for joining in and giving us a heads up as to how business is shaping, what the outlook is in particular focus as well on your individual businesses.